the World Bank just upgraded India's growth forecast. That sounds like a win. And it is. Mostly. But there's a storm brewing in the background, and it's already hitting your wallet. Here's the full picture. The World Bank has revised India's growth forecast for FY27. That's the financial year ending March 2027. Up to 6.6% from an earlier estimate of 6.3%. On the screen, you can see that upgrade right there. Looks great, right? Sure. But hold on. India clocked 7.6% growth in FY26. So yes, we're going up on the forecast revision, but we're actually slowing down from where we were. Think of it like your business pulling in 1 crore 20 lakh rupees this year after doing 1 crore 50 lakh rupees last year. Still profitable, still in the green, but the momentum has quietly dipped. And the reason why matters a lot. It comes down to one word: oil. The ongoing conflict in West Asia is pushing energy prices up, and that's triggering what economists call a polycrisis. Basically a perfect storm where multiple problems crash into each other and make everything worse all at once. High winds, heavy rain, and a high tide all showing up together. Each one alone, manageable. Together, they flood your shop. And you can see exactly how that plays out in the numbers on screen right now. India's current account deficit, which is essentially the gap between what we earn from the world and what we pay out for imports like oil, is expected to widen to 1.8% of GDP in FY27. That's up from near zero last year. Bigger oil bills, bigger gap, simple as that. On top of that, the government's fiscal deficit, the gap between tax revenue and government spending, is projected at 7.6% of GDP, about 0.3 percentage points higher than it would have been without the conflict, because higher oil prices mean bigger subsidies on fuel and fertilizers. So the bottom line is this: India's economy is resilient, no question, but it's navigating very real headwinds right now. And those headwinds don't just stay in spreadsheets. They show up in your business costs, your loan rates, and your customers' ability to spend. So that's what's happening. But here's the real question: why isn't India in full panic mode? What's actually cushioning the blow? That's exactly what we're getting into next. So now that we know the big picture, the real question is, where does your business actually land in all of this? Because not everyone loses. Some people are quietly winning right now. Sound familiar? That feeling when your input costs go up but you just cannot raise your prices yet? Yeah, that tension is playing out across entire sectors right now. Let's talk winners first. If you're in oil and gas, or you hold shares in companies like ONGC or Reliance, higher crude prices are actually good news for you. Revenues go up when oil goes up, simple as that. Gold holders are smiling too. Gold has already jumped 663 points on pure safe haven demand. That is investors panic buying gold when the world feels shaky, and that trend is rising fast, as you can see right here. Gold traders, jewelers, investors, all cashing in. And here's one winner most people miss: export-oriented businesses. If the rupee weakens under oil pressure, your IT services, your pharma exports, any dollar-earning business suddenly becomes cheaper for foreign clients, which means more competitive, which means more orders. A weaker rupee is a quiet pay raise if you earn in dollars. Now the losers. And this list is longer. Airlines, logistics, any business bleeding on fuel costs. They are getting squeezed with no easy way to pass it on. Refiners are caught in a margin trap. Real estate and auto, watch out. If oil pushes inflation higher, the RBI may hike the repo rate. That is the rate banks borrow at, which flows straight into your home loan and business loan EMIs. A 25 basis points hike on a 50 lakh rupees business loan adds roughly 1,200 to 1,500 rupees to your monthly outgo, every single month. And consumers overall, higher fuel and fertilizer subsidies mean the government either cuts spending on roads and hospitals, or hikes taxes. Either way, your customers end up with less money to spend. So where you stand in this story depends entirely on what you sell, what you import, and how rate sensitive your business model is. But here is what ties all of this together. India actually has some shock absorbers built in. Next, we look at exactly what those buffers are and whether they are strong enough to hold. But here's the thing. India didn't walk into the storm empty-handed. And that changes the calculus significantly. Basically, think about this. India's forex reserves right now cover more than 10 months of imports. 10 months. That's like a family that suddenly loses their income, but they've got nearly a year's worth of living expenses just sitting in a savings account. No panic, no fire sales, no desperate borrowing. They can breathe, adjust, and wait it out. That's the position the RBI is operating from, and on screen you can see exactly what that buffer looks like. It's not a thin cushion, it's a serious wall. What that does for you practically: two things. One, it puts a floor under the rupee. The RBI can sell dollars from that reserve pile to keep the currency from going into free fall. Two, it signals to global investors that India isn't a wobbly bet right now, which keeps money flowing in and keeps bond yields. Basically the interest rate the government borrows at, which then bleeds into every lending rate you deal with, from spiking out of control. And inflation being under control right now gives the RBI even more breathing room. If they hold a neutral stance, not cutting, not hiking, bond markets stay calm. Your borrowing costs don't suddenly jump on you overnight. Now that said, This safety net isn't infinite. If oil prices stay stubbornly high through FY27, the fiscal deficit could push past 7.6% of GDP. And at that point, the government faces some ugly choices. Cut subsidies, which raises your fuel and input costs directly. Pull back on public investment, which slows demand. Or borrow more, which pushes rates up. None of those are fun. So what do you actually do with all of this? If you're planning a big loan or capital investment, move sooner rather than later before any potential rate action catches you off guard if your business is import heavy. Raw materials, electronics, machinery. Start mapping your currency exposure now and look seriously at hedging. And if you're export-oriented, this might actually be your moment. A softer rupee is a pricing edge. Use it aggressively to pitch international clients while the window is open. India's fundamentals are genuinely solid, but the global pressure is real. The businesses that plan before the flood, not after, are the ones that come out ahead. That's your full picture. The risks, the ripple effects, and the playbook. Stay sharp, stay ahead. Follow us for more updates like this. Thanks for watching, and don't forget to follow us on YouTube, Instagram, and X.